David ran an $850,000 financial advisory practice. He could rattle off his margins, revenue targets, and headcount costs without checking a single spreadsheet. He operated with the confidence of a founder who had total visibility into his firm's performance. That confidence vanished during a quiet Tuesday in December when he decided to run a routine audit of his accounts receivable. He expected to spend 2 hours confirming his numbers before the year ended. Instead, he spent those 2 hours calculating the cost of his oversight. This bar chart represents David's annual revenue. He discovered $67,000 sitting in unpaid invoices, some aging past 60 days, others past 90, and one that hadn't been touched in over 6 months. That represents a full 8% of his yearly revenue, completely detached from his bank account. Every dollar of that $67,000 represented work already completed and value already delivered. David had spent the entire year working harder to hit new growth targets, while nearly a tenth of his existing output was simply floating away. David's discovery reflects a standard operational gap found across the entire professional services industry. This timeline shows an invoice's typical lifespan. SBA data reveals the average firm waits 45 days after finishing jobs to see payment. Within this gap, risk increases. NAPFA reports 9 to 12% of professional service invoices are abandoned entirely or require legal action. This raises a specific question. Why does a successful company's revenue consistently disappear into this post-billing void? Treating a 6-week delay as a standard cost of doing business obscures the reality. This delay is a structural failure that limits a founder's available working capital. The trap remains open because most firms lack dedicated ownership over the accounts receivable process. Notice the break in this workflow. On one side, sales and delivery teams move quickly to the next project. On the other, accounting passively waits for money to arrive so they can record it. This creates the AR gap, a space where follow-up is expected but rarely assigned. CFO David Earhart points out that when a task is perceived as everyone's job, it effectively becomes no one's job. Without a specific person responsible for the gap, invoices stay stationary until they are forgotten. Relying on a client's memory instead of a formal management system means a business is no longer controlling its cash flow. It is simply hoping for the best. Founders often assume that an unpaid invoice is a sign of a difficult or evasive client. The reality is much more mundane. David's audit revealed that one client simply forgot, another had a new billing contact his team never updated, and a third had an unanswered question from 3 months ago. Trapped revenue is rarely caused by client hostility. It is usually the result of minor behavioral friction meeting a total lack of internal follow-up. The damage of a late payment is not a static number. The operational cost of an unpaid invoice increases every day it sits in the ledger. The Institute for Supply Management found that a 30-day payment delay creates an average operational impact of $1,500 per client. This impact shows up as frozen capital, unpredictable cash flow, and strategic decisions that have to be deferred because the money isn't available to deploy. Piper Sandler's analysis highlights a more efficient path to growth. Improving your collections time by 10% has the exact same impact on your cash flow as increasing your total sales by 10%. But it requires significantly less effort to execute. Attempting to solve a collection problem by relentlessly hunting for new sales is the most expensive way to run a business. To recover this capital, you have to separate accounts receivable from the accounting department. Mercer Bullard suggests viewing AR as a client relationship function. From this perspective, an overdue invoice is a symptom of a client problem that hasn't been diagnosed yet. Moving from an adversarial demand for payment to a service-oriented check-in removes the tension. It allows you to address the friction that is holding the payment hostage. You can fix this by following a 3-step protocol. First, perform the audit. Categorize every invoice past 30 days by its friction type. They simply forgot, had a question, or wrong contact. Second, assign ownership. Select one person whose primary performance metric is the number of days an invoice stays outstanding. This person's role is to contact clients with the intent of solving problems. They call to ask how they can help remove whatever roadblock is preventing the payment. Third, use automation to address friction before it becomes a long-term problem. Program your software to send helpful emails at 15, 30, and 45 days. Including a simple survey asking if the client has a question about the charge can surface issues while the work is still fresh. These 3 steps replace a passive gap with an active system, ensuring that your earned revenue is no longer held hostage by avoidable friction. For many professional service firms, the struggle to scale is actually a collection problem disguised as a growth problem. Stop working for new money while leaving 8% of your earned cash on the table. Identify where it is, assign someone to own it, and collect it.